Hi there, Mark Anderson here, mortgage banker with Paramount Bank. I'm licensed to lend in all 50 states, and I would love the opportunity to help with your mortgage. Please do call or text me at the number below anytime if you have any questions about your mortgage. If you want to take a look at a refinance or a purchase mortgage, I would be more than happy to help you. I look forward to hearing from you. For today's mortgage rate update, we are going to talk about the news that came out last week where the big mortgage agencies, Fannie Mae and Freddie Mac, have made refinancing more expensive. Now, the first thing that we're going to look at in this video before we touch on that specific issue is we're going to take a look at the bond prices as always. Now, the fundamental technical relationship between mortgage bonds and interest rates is as mortgage bonds are priced higher, mortgage rates tend to go lower. Now, that is the standard relationship between the bonds and the rates, but as I have covered in this video series, the pricing in this crazy low rate environment has actually been a little bit more complicated. There are other factors that drive the day-to-day market movements of mortgage rates. It's not just bonds. Where we'll start, though, is I will share with you that bonds today are at a very high level, over 105. But again, this is not the only factor driving the current low interest rate environment. Now, a week ago, when Fannie Mae and Freddie Mac came out with this new I hesitate to call it this, but I think it's only fair to say that it's essentially a cash grab. What they're doing is for all refinance transactions, even those that have already been locked in, Fannie Mae and Freddie Mac have just said they're going to take 0.5% of that loan amount in revenue off the table, and they're going to pocket it for themselves. Now, I'm not going to weigh in on whether or not I think that that's fair. I'm not going to weigh in on whether or not I totally get it. But what I can tell you is that this has impacted mortgage rates in a bad way. The rates, to be clear, are still incredibly low. But you'll notice that I've updated the stair-step chart to indicate that we are at one step above the lowest rates that we've seen during this low rate cycle here in 2020. Now, what Fannie Mae actually says, we're going to flip over to their lender letter. This is the way that Fannie Mae and Freddie Mac communicates to the lending industry. They issue these letters, and this letter is pretty simple, and what they state is, in light of market and economic uncertainty resulting in higher risk and costs incurred by Fannie Mae, we are implementing a new loan level price adjustment. And the long story short there is they're taking 0.5% off the table, and that has caused lenders to have to make their interest rates a little bit higher, because they have to be able to absorb this new fee that's paid to Fannie Mae and Freddie Mac. Now, one thing I could say potentially in the agency's defense is that if you look at the way loans are backed and where the money actually comes from, it is the case that Fannie Mae and Freddie Mac are the folks that actually get the money. They essentially get the money from institutional investors on Wall Street, and they fund and hold these loans on their books. Now, you have some other institutions involved in this kind of mortgage supply chain, and that is what I oftentimes refer to as the, quote, big institutional lenders. These are big banks that you've heard of. There are plenty of outfits that you haven't, but they essentially control what's called the loan servicing market in the United States. Fannie Mae sets a price based on the bonds. From there, the institutional lenders add their margins. One of the things that happened early on in this low rate environment is that there were legitimate concerns that these servicers had over defaults, slow pays, forbearances, foreclosures, etc. As so many people lost their jobs so quickly, this was a very legitimate concern. And so the thought process probably went something like this. Yes, we're getting a lot of new business coming in due to the low rates. Everybody is refinancing. But number one, if you're a mortgage servicer, that's not automatically good news, because it means that you've currently got clients paying at these rates, they're now paying these rates. That's not necessarily a total benefit for you, although there is additional revenue coming from the mortgage agencies in that process. But despite the heavy business coming in, there are two considerations that they had to account for. One, the risk associated with all of the things I talked about as far as forbearance, foreclosures, et cetera, meant that they would be losing money on a lot of the transactions that were on their books. So the new business coming in, it made sense for them to charge higher margins than maybe they normally would, especially as the rates were already so low overall. You figure there's room in there to charge and make a little bit more on a per transaction basis. Maybe they get to offset some of the potential losses which again, especially at the beginning of this, nobody knew how bad it was going to be in terms of forbearance foreclosures. It's likely we still don't know the full extent of the damage that could come from that from the mortgage servicer's point of view. You also had a very practical consideration that I've talked about a lot in this video series, and that is capacity. There are human beings behind the big names of these big banks and institutions that have to do, let's call it the human logistics of getting a loan done, booked, serviced, etc. And there's only so much that those individuals can take on at a given time. Volume, I don't know what the percentages are, but mortgage volume across the United States surged and kept surging some more. And so there was a legitimate concern that maybe they aren't going to have the capacity to service the new business coming in. That's another aspect that caused them to kind of crank the margin knobs up a little bit to earn some additional revenue. So all this put together, where I'm going with this is, there has been for some time now a disconnect, let's say, between the super high bond prices and where the actual rates on offer are for the consumers. You've got that element of these institutional lenders monkeying with the margins a little bit and taking more than they otherwise would. With this announcement from the big mortgage agencies, Fannie Mae and Freddie Mac, they're essentially doing the same thing. Now, I think as they state, this is a higher risk environment, and Fannie Mae and Freddie Mac are the ones ultimately that are actually holding these loans. So as much as slow pays, forbearances, defaults, foreclosures, etc., negatively impact the servicers, you could make a very strong argument that it impacts the mortgage agencies more because they are the ones that are actually holding these loans and backing these loans. So it is perhaps no surprise that they've kind of joined the party in taking more money off the table given how high the volume is and given the risk environment that we happen to find ourselves in. Now, I don't know if this is going to be a permanent thing. It's unlikely to be. At some point in time, this extra fee will go away. My guess is that it could take some time for that to show up. But just to make the point again, if we didn't have this extra fee to Fannie Mae, and if the big institutional lenders were not as worried about the risks for all the things that I've talked about, we would see even lower rates than what we have right now on our rate sheets, just based on where the bond prices are at. And where I'm going with this overall is I think rates are going to continue to stay very low for what I'm going to say is the foreseeable future. In order for the rates to go up in a meaningful way, not just a little bit, which is we've only seen a little bit of an increase in rates here recently. In order for them to go up a lot, I think there would have to be a fundamentally different market. And you would have to see much, much lower bond prices if the stock market continues to do well. And let's say there's continued good news maybe about COVID, a vaccine, something tangible that's going to resolve the risk associated with this virus. You would actually see naturally at that point bond prices come down because that would be a good thing for the stock market. Anything positive in the economy is going to generally cause stocks to go up and bond prices to go down. But even if bond prices go lower, what you're probably going to see at that time is Fannie Mae maybe get rid of this extra cash grab. Maybe you'll see the big institutional lenders put their margins back down to normal levels. So the way I view this is that this is essentially an indication to me that we are going to be in this very low interest rate environment for a long time. Things could change very quickly. I'll be here to report on that if there is some big change. But if you have not yet locked a rate, let's say you're looking to buy a house right now, I wouldn't worry about these rates jumping overnight. I really wouldn't. There would have to be something major and dramatic that would change to actually impact rates for the worse in a significant way. So again, thank you for watching the video. Please do subscribe to my channel. If I can be of any assistance to you as you evaluate your mortgage options, please do call or text me at the number below anytime.